What if there was a checklist, 6 conditions, that could help you find a stock that turns $10,000 into $1 million? Not a hot tip, not speculation. A framework built from studying 365 real companies that actually did it. That framework comes from Chris Mayer's book, 100 Baggers. Mayer doesn't lay it out as a numbered checklist, but across the book, 6 conditions show up in almost every company that made it. Today, I'm going to walk you through each one, show you the companies that proved they work, and then run one stock through all 6. In 2015, Chris Mayer published 100 Baggers after studying every stock that returned 100 times its value between 1962 and 2014. 365 companies. Every industry: insurance, railroads, retail, tobacco, technology, consumer goods. The top results alone are staggering. Berkshire Hathaway returned 18,000 times your money. Kansas City Southern, 16,000 times. These figures come directly from Mayer's study, multiples, not percentages. His conclusion? The industry almost doesn't matter. What matters is a small set of characteristics that show up again and again across every single one of them. His philosophy in 2 words: buy right, hold on. To turn $10,000 into $1 million, you need a 100-to-1 return. Here's what Mayer found. At 14% per year, 35 years to get there. At 20% per year, 25 years. At 36% per year, just 15 years. You don't need a lottery ticket. You need a business that keeps earning returns on top of returns, what investors call compounding, at above-average rates for a long time. Mayer found that the median company in his study took 16 years to hit 100 times, not 16 months, over a decade of holding. The only generalization Mayer could make about all 365 companies: they grew for a long time at a fast rate. The reason is arithmetic. A company growing earnings at 20% per year doubles its earnings roughly every 4 years. After 20 years, it's making 38 times more profit than when you bought it. That earnings growth is what drives the stock price. Amazon grew revenues at extraordinary rates for over 2 decades, from books to everything to cloud computing. Monster Beverage grew revenues dramatically in the early 2000s as their energy drink took over shelf space across the country. In both cases, the growth was structural, built into how the business worked. You're not looking for a company that had a good year. You're looking for a business whose growth engine just keeps working.
Growing fast is not enough. The second condition is what the company does with its profits. Mayer explains this through return on capital, how much profit the business generates for every dollar it puts to work. As Jason Donville, quoted in the book, puts it, over time, the return of a stock and its ROE tend to coincide quite nicely. The best 100 baggers reinvested profits back into the business rather than paying them out. Amazon showed almost no profit for years because Bezos reinvested everything into warehouses, servers, and new product lines. If you added back the research and development spending, you'd see a business with strong underlying economics, deliberately delaying profit today to build a much larger engine for the future. Comcast did the same, investing heavily to acquire cable subscribers for years before showing profits. That reinvestment engine compounded for decades. High returns on capital, profits reinvested, not paid out, value building quietly in the background. Here's where most high-growth businesses eventually fail. A company can grow fast and earn high returns, but if a competitor can simply copy what it's doing, offer the same product cheaper, replicate the model, undercut the margins, those returns get competed away. Mayer calls this the moat. He points to several kinds in his case studies. Gillette had patents, continuously improving their razors and protecting those improvements. Electronic Arts locked up exclusive sports licenses, most notably the exclusive NFL license for Madden, giving them a dominant and largely uncontested position in that category. Comcast had infrastructure, a cable network that cost billions and years to build. No startup could replicate it. His core point, you can only keep reinvesting at high returns if competition can't erode those returns. Without a moat, the compounding breaks down. With one, it compounds.
Mayer makes a clear distinction between two types of management. The hired manager, a CEO with no personal stake, who optimizes for their pay and bonus and thinks in 3-year cycles. And the owner-operator, a founder or large shareholder running the business with their own wealth at stake. He cites investor Martin Sosnoff directly. If management and the board have no meaningful stake in the company, at least 10 to 20% of the stock, throw away the proxy and look elsewhere. When the CEO owns a large chunk of the company, they're thinking about what the business looks like in 20 years, because in 20 years, they'll still own most of it. Sam Walton ran Walmart himself for decades. Jeff Bezos was Amazon's largest individual shareholder through its entire explosive growth phase. Warren Buffett has always been Berkshire's largest owner. In every case, the owner-operator made decisions a hired manager would never have made, sacrificing short-term profit for long-term compounding. This condition is about mathematics. Mayer found the median company in his study had a market value of around $500 million at the start of its 100x journey, small enough for the math to work, large enough to be proven. A company worth $500 million needs to reach 50 billion to 100x. Hard, but it has happened many times. A company worth 50 billion needs to reach 5 trillion. That is essentially impossible. The room to grow has to exist. The smaller the starting point, the more room there is to grow. The final condition isn't about the business, it's about the investor. Mayer makes this point directly. If you buy a stock returning 20% annually for 26 years, you get close to a 100-bagger. But if you sell in year 20, you only get around 38 times your money. You leave the rest of the compounding on the table by selling 6 years early. The investors who made fortunes in Amazon held through the dot-com crash when the stock fell sharply. They held through years of the stock going nowhere, through analyst downgrades and bad quarterly numbers. Most investors sell too early. They watch a great business double, take their profit, and give away the compounding still ahead. The biggest returns don't come from timing the market. They come from finding the right business and getting out of your own way. These 6 conditions work as a system. High growth creates the earnings trajectory. Reinvestment at high returns turns that growth into compounding value. Competitive advantage protects those returns from being competed away. An owner-operator ensures long-term decisions. Starting small makes 100x mathematically possible, and patience means you capture the full journey. Remove any one, and the system breaks down. A high-growth business with no moat sees its returns competed away. A business with a moat but no growth just sits there. A great business worth 500 billion has no room to 100x. All 6, together, over time. That is the formula.
Now let's run one company through all 6. Quickly. HIMS and Hers Health, a telehealth platform that sells directly to patients with no middleman. Online doctor visits, prescription medications, its own pharmacy that makes custom medications, and a manufacturing facility that produces those medications in-house. Ticker, HIMS. High growth? Revenue went from $272 million in 2021 to $2.35 billion in 2025. First full-year profit in 2024. Confirmed. Reinvestment at high returns? Return on capital figures for 2025 vary significantly by methodology. The $1 billion convertible debt raise, essentially a loan that can later be converted into company shares, inflates the total capital figure used in the calculation and makes comparisons difficult. Strip out the uninvested cash,
and the underlying returns look meaningfully positive. Watch where the capital gets deployed: labs, blood testing subscriptions, and in-house medication manufacturing. Confirmed with a flag. Competitive advantage? 3 layers. 2.5 million subscribers generating years of personal health data. Leave and you start from scratch with a new provider, losing your integrated care history and treatment continuity. An owned medication manufacturing facility that took years and regulatory approval to build. And then there's the Novo Nordisk relationship, which is complicated. Novo first partnered with HIMS in April 2025, then terminated that partnership in June 2025, publicly accusing HIMS of deceptively promoting unauthorized compounded versions of their weight loss drug Wegovy. The stock fell 34% on that news. Novo then sued in February 2026 for selling products that used their patented drug without authorization. 28 days later, Novo dropped the lawsuit, though explicitly reserving the right to refile, and entered a new collaboration where HIMS acts as a distribution channel for Novo's branded products in exchange for stopping promotion of compounded alternatives. This is not a clean story, but the fact that Novo kept coming back despite terminating once suggests HIMS' subscriber scale is difficult to walk away from permanently. Confirmed with significant caveats.
Owner-operator? Andrew Dudum co-founded the company and is still CEO, running it around a publicly stated personal mission: building a healthcare system that catches problems before you get sick, not just after. Confirmed. Small enough to grow? Market value has been highly volatile, ranging from under $4 billion to over $6 billion in early 2026. Regardless of where it sits on any given day, the company remains small relative to the $5.3 trillion U.S. healthcare market. There's room to grow. Confirmed. Patience required? Multiple government investigations are ongoing, including probes from the DOJ, SEC, and FTC. A shareholder lawsuit is in progress. Over a third of the company's tradable shares, at times approaching 43%, are held by short sellers betting it fails. The story the market is currently telling about HIMS is dark. That is exactly where Mayer's framework says the opportunity tends to live, in the chapters that feel most uncertain. Confirmed. 6 conditions, all 6 confirmed. That doesn't make HIMS a guaranteed 100-bagger. Nothing in investing is guaranteed. But the framework gives you a way to evaluate it, based not on this week's news, but on the structural characteristics that produced 100-baggers across 50 years of history. That's the power of Mayer's framework. It doesn't predict the future. It identifies the conditions that make extraordinary returns possible. And then it asks you to do the hardest thing in investing: get out of your own way and let time do the work. Buy right, hold on. Apply this to every stock you consider: high growth, reinvestment at high returns, competitive advantage, owner-operator, small enough to grow, patience. How many boxes does your stock check? Follow for weekly investment analysis. Next week, why the company that owns your health data over the next decade may be worth more than any hospital system alive today.
One last thing. The content in this video is for reference only and does not constitute investment advice. All investments carry risk. Please make your own judgment based on your personal circumstances.